Well, good evening, everybody, and welcome to the August 2024 Investing Roundtable, sponsored by the Mid-Michigan chapter of Better Investing and Manifest Investing. This is Ken Kavula. I'm a director with the Mid-Michigan chapter, and I'm joined by my good friend Mark Robertson, who's also a director in the Mid-Michigan chapter. And this evening, we're going to feature three folks that are guests to the roundtable. Kim Butcher, who's a frequent guest, and her home is in Southern Illinois, in Evansville. I'm sorry, Kim, Southern Indiana. Her home is in Evansville, Indiana, but I think she's going to be making a new home down in Florida fairly soon. We're also joined by two directors from the Houston chapter of Better Investing, and that's Ann Manning and Matt Spielman, and they've been our guests before at various times as well. They're all three good presenters, and we're in for some pretty decent stock picks today. So without further ado, let's talk about our disclaimer here. Mark, if you can give me one click. And everything we do tonight, even though we're talking about real stocks in real time, everything's for illustrative but educational purposes. We're not making any recommendations to buy, sell, and hold. The only recommendations we're making are to put these stocks into a tracking portfolio that's made up of imaginary money where we keep track of the stocks. We've been doing this for over 14 years now. We're in our 15th year, and Mark will talk a little bit about our performance in just a bit. If you'd like to be added to our guest list, go to betterinvesting.org and look for the Mid-Michigan chapter. Scroll all the way down to the bottom of the page, and you can fill out a very brief form. Only asks for three things, and once you subscribe, you'll be added to our guest list, and we can then send you an email telling you about the roundtable. If you'd like slides of tonight's presentation, send an email to Mark or myself. Those are our email addresses at the bottom of the slide. And we also post these presentations on the Manifest YouTube or Manifest Roundtable or Mid-Michigan Roundtable. They'll all get you to our channel on YouTube. And once you get to YouTube, you'll see everything that we've been doing for the last 14 plus years. And you can look at one or many of those if you so choose at your leisure instead of coming live to the program. Let's go to the next slide real quick and talk a little bit about what we're doing. We got together over 14 years ago and decided that we were going to meet once a month. And four of us, the original knights, were Hugh McManus from Pasadena, California, Cy Lynch, who's still a very active knight from Atlanta, Georgia, Mark Robertson from Rochester Hills, Michigan, and myself from Genesee, Michigan. And we decided we'd give our best stock idea. We'd keep track of how they were doing. And our goal was to try to beat the market on a regular basis by at least 5 points if we possibly could. We call that relative return, how much you beat the market by. And we also had a secondary goal. We would like to have beaten the market by at least 55% of our choices. You can see that we've just gone past that relative return of +5 again. The orange line on the graph represents +5 to the market, and the market's being measured by the Wilshire 5000. In our history, the Wilshire 5000 over those 14 plus years has returned a little bit better than 12%, and our investments, both with the buys and the sells that we've made, have returned at 17.4%. So we're beating the market as of today by 5.2%. Again, 14 plus years of history. Yes, everybody can do this. There's not a professional investor in the whole group. We're very interested, active amateurs, and we've been working really hard to keep this line above the orange line. We've managed to do it. Our accuracy rating has stuck at a little bit less than 50%, somewhere between 46 and 48%. We really would love to get that above 50 if we possibly could, but we're very content with beating the market with our 46.8 accuracy performance. Next slide, if you would, Mark. Here's our top 20 holdings. You can see that our biggest holding by far is Microsoft. We've only chosen it 5 times in our entire history. If you look up at that set of letters and numbers in the upper right-hand corner, you'll notice a 5X, and you'll notice after the 5X comes MSFT, that's Microsoft. That says that we've chosen Microsoft along with Adobe and a few other stocks 5 different times, and that 5 times has resulted in more than $100,000 in our portfolio coming from Microsoft. Here's the top 20. There's a couple of interesting ones on the list. Costco is a one-time choice. Our only regret is we didn't choose it more than once, but it's made almost $19,000 in the one-time choice. And you can see that this is a fairly decent list. You go over to the extreme right-hand column of the potential annualized return as measured by Manifest that uses data coming from Y charts. That data is indicating that some of these stocks are pretty decent buys even in today's market. We're not recommending that you buy any of them, but those that are in green, that one with a light orange background, they might be very interesting stock studies, and you might find it very refreshing to come up with some buys in a market where finding buys right now is a little bit more difficult than it has been at various times in our 14-year history. Let's go one more slide if we could, Mark. Here's a list of our portfolio, and this is the way we actually keep the portfolio. Every time somebody makes a pick, we put their name next to the stock, and then we keep track of it based on what its price was at the time we chose it, and we put $1,000 into it, and then we look at the price today. We look at what the market would have done from the time we bought it until today. That's the second last column. And then we look at the relative return, how much the stock is beating the market or losing to the market. It doesn't mean that 3M is a terrible company. Its annualized return, since we bought it, is 19.5%, and we've owned it for almost exactly 2 years. Mark chose it back on August 30th, 2022, and the audience agreed that it was the best stock that night, and it's keeping up almost exactly with the market. It's lagging by less than 1% right now. The very next one on the list, CBOE Global, was chosen a couple months after 3M. Its annualized return is 14.6, and its annualized return is 30.2. The market has returned 14.6, and there's that relative return, one minus the other, of 15.6. That first column way over on the left, that's the RSI, the Relative Strength Index. And when that hits 80, that's a signal that we might want to take a look at the stock for liquidation purposes, that it's probably what the market calls overbought. And it might stay in that position for quite a while on overbought. A lot of times you'll read that the dividing line is at 70, but we like to set it a little bit stricter at 80 so that we don't get rid of stocks that might turn out to be extremely good investments. Right now, we're going to put one of the stocks on the hot plate, and we're going to freeze the investment in that stock. And I'm going to turn the mic over to Mark, and he's going to tell us why he thinks Forward Air would be a great stock for us to freeze at this particular point. Mark?
Yeah, if you're out there in the audience and you're not familiar with this relative strength index, it's not something that is, widely used by people within the community, but what it represents is what I would think of as a momentum or a sentiment indicator, and it's actually fairly short term. It's looking at price movement over the last few weeks. And the way that we use it is just simply to be nudged to possibly trim the portfolio from time to time. We have not done this for many, many months. But in this case, for example, we had no companies above 70 a couple of months ago, and now we have this fairly long list. So that just basically means that, and you guys all know this, the stock market's been hot, and companies like PayPal have shown signs of recovery. Green Brick has been strong, and so these are the companies that have been hot, as Ken's mentioned, possibly overbought. So we're going to put Forward Air on the hot seat. The reason that it really kind of grabs our attention is it's been a train wreck for over a year. You see that with the stock price dropping here. This is a very long-term chart. The stock price has been going down dramatically, but the stock price has gone from pretty close to $10 a share up to $33 a share in a little over 3 months. So that's a huge pickup. And so the list that you see here is just simply taking a look and auditing a little bit, but taking a look at the companies and ranking them by their manifest rank. So these would be the companies that have the weakest combination of quality and return forecast. And Forward Air certainly fits the list. In fact, it's the only one that triggers what might be a sell zone. And again, going up from $10 to $33 in a couple months probably can account for that. And so we decided to take a little bit closer look. Here's a look at the fundamentals of the company. The short story here is they are in a pretty sizable merger with another company, and I haven't read a good word about it yet, Ken. So I mean that's how ugly it's kind of gotten. This is how
It's
ugly it's gotten.
it's more like an arranged marriage where the two people aren't even speaking to each other. So it's not very pleasant at all. It's Forward Air's having a very difficult time, and they're having a very difficult time explaining it to the market about what the
Exactly.
problems are as well. So
It reminds me of that time you were getting letters from the company begging you to vote based on the brawls that were going on in the boardroom. So you basically have a company now, thanks to this $33 stock price, the return forecast, the projected annual return is down low single digits, and it's just kind of a mess. So here's a look at
what I like, before you get off that slide, Mark, I also like the fact that the proof, which we've been talking about, Mark and I have for about a year and a half now, the proof value kind of verifies that 2.9%. It's at 3.5. This is a completely different way of coming up with a return value, using numbers that aren't based on PE. And when it kind of validates the traditional method of coming up with a return that is the stock selection guide. The 2.9 comes from a stock selection guide, and then this proof calculation verifies our analysis. And what more can we say? This stock doesn't have a lot of forward potential to it anymore, and we're going to try to take it out of the portfolio.
And it's true that one of us did consider naming a grandchild. This company was really good to us for many years in the best small companies. Here's a major challenge or opportunity for improvement at this company. I mean, the profitability, whether you're measured at the bottom line or the operating line, has been deteriorating for quite some time, and it's just kind of a mess. And then here is the most recent value line close. Again, keep in mind that this analyst was making this comment just a little over 2 weeks ago, and the stock price was closer to 20. So my suggestion is we lick our wounds and we walk away with, what do we got here? We're actually walking away with a few dollars. And that, again, keep in mind that that number was 60 or 70% lower just a month ago. So there you go. So that's it for now. Notice that Portillo's is near the bottom of that, or top of that list. That's not comfortable.
I'm noticing Portillo's. I'm noticing Ardelyx on that list. I'm noticing a number of different names I'd like to get my hands around here. So we'll have to talk about this list again at a future roundtable, Mark. Okay.
Well, we're not going to let this go because this is a good way to take a look at the portfolio and look for opportunities to make it stronger. And
Absolutely. We
we
also
will.
have beer to go with our hot dogs there, I notice. Okay.
Yeah,
So
Boston Beer's on there too. Yeah.
yeah,
All right.
okay.
So that's it. We will go ahead and sell um, Forward Air from the portfolio and go looking for better companies to make the portfolio stronger. So with that, we're going to go ahead and start with Ann Manning from Houston. Notice,
Good
Kenneth,
evening, everyone.
Houston's taken over the territory here. Gotta
Right.
watch them.
Mark, before we start with Ann, I'm going to try to answer a question from Bill here. Bill, you're self-muted, so if you unmute, you can talk to us. Okay, Bill, you're unmuted. Go ahead.
Is the chart for the individual purchases on Roundtable available online, or
The complete list would be tough to put online, but I'll think about how we can handle that.
okay, thank you.
Okay. Thank you, Bill. Okay, Ann, take it away.
Okay, good evening, everyone. I chose Lululemon for my stock tonight. This is a Canadian company that was started by Chip Wilson in 1998. He's considered a pioneer in athletic leisure wear. He wanted to have a product that was designed, produced, and sold without a middleman. The first time I heard the name Lululemon, I'm like, what the heck is that? I couldn't imagine somebody naming a company that. And this guy must have had a really good sense of humor because he decided he wanted a funny name, and I think he got it. He chose all the L's because Japanese consumers, who are a big part of their business, like the names with L's in them. So he came up with this name to have 3 L's in it. And he wanted to see how people would try to pronounce the name. So I thought that was pretty funny that that's how they came up with the name. Next slide, please. This just gives you an idea of how much they've grown since 1998. I can imagine their first retail space was a little corner inside of a yoga studio in Vancouver. And they certainly have come a long way since then. If you'll go all the way down to 2021, they are in a partnership with the Canadian Olympic Committee to be the official outfitter of Team Canada through 2028. So that was a really great PR for their company. They, have continued to, be out there and promote themselves. Next slide, please. You can see how their stores have grown worldwide since 2012. It's amazing how many they have. You can see all the different countries or areas of the world that they are in, and they continue to grow each year. Next slide. I always like to look at the CEO of the company. Kevin McDonald has been with them since August of 2018, and he certainly comes with a lot of experience in retail. He's been Loblaw, which I'm sure if you lived in Canada, you would know who they are. And then see who, Sears Canada, and then he was with Sephora with Louis Vuitton, which I think we've had in the roundtable before. So he certainly comes with a lot of experience in the retail business. Next slide, please. They started off basically as yoga outfits, but if you go to their website, you will find that both men and women is athletic leisure wear, and they have a variety of things that they sell. And as you can see here, it's not just yoga pants. Next slide, please. They developed their own products. They are known for their wild patterns, as you can see here. These are the areas that their products are known for, and that's why people go back to them over and over again. I don't personally own any of the leisure wear, but from the people I have talked to that do buy it, they are very loyal customers and they keep going back. Next slide, please. If you remember, they started out in a yoga studio. And one of the things they've done starting in 2019 is open up large stores. And inside the store, there is a yoga studio. Instead of them being in a yoga studio, they've switched it around. I don't know what the next HILT studios, I meant to look that up and I forgot. They have mediation space, smoothie and coffee fuel bars, and areas for community events, which they are very much into doing community events. They also have started doing pop-ups, and those are temporary retail spaces that they use to promote their products for a limited time. It can be a matter of days or weeks. Usually it's in conjunction with an event, and they seem to have done real well doing these pop-ups. Next slide, please. In 2019, they initiated an effort called the Power of 3 x 2. They had 3 areas: product innovation, guest experience, and market expansion, that they wanted to double these areas, 3 areas in 5 years. Well, they did it in 3 years the first time. So in 2022, they initiated the same goal again for the next 5 years to double their business to $12.5 billion by 2027. And I can tell you, they're already in line to beat that deadline. As you can see on the right, this is their first quarter earnings for this year, and obviously they, continue to do well. We'll see how it goes this week. They report their earnings on Thursday the 29th, so hopefully they'll continue to do well. Next slide, please. These are the financial ratios, which I have shown y'all before. If you look at the numbers, Lululemon's numbers are incredible. I don't understand why number 3 and number 5, Morningstar does not have that information. But as you can see on 1 and 2, they more than beat what you need to have a good ratio for this. Next slide, please. This is manifest equity analysis of Lululemon. As you can see, they're a very high quality company. The PAR is 17%. This was done as of Friday's price. Today's closing was $271.18. So it's kind of hard to get a better quality with this kind of PAR. And if you look at the approved and the PAR, they're very close together. Next slide, please. This is my front of my SSG. I put the value line sales in so you can see that it is in line with the analyst consensus for the other years. And it also puts my projection in line with those trend lines. I went with 12. On the right, you'll see others forecast. The company itself is saying it would be 12%. Member sentiment is 10.9 and manifest is 15.6. So I felt comfortable with my forecast of 12, both in sales and EPS. Next slide, please. As you can see, this is a very well-run company. Their pre-tax profit and their return on equity is in good shape, and they have low debt. I did put in the quarterly data. As you can see over to the right, they are lower than what they have been in the past, but they are still continuing to make good money. Next slide, please. I have a question on what I did on this, and maybe some of the guys can help me because I've never done this before. As you can see, I X'd out 3 years because they are so much higher than the other ones that they were just way out of proportion. And the PE has continued to go down. So I'm asking, was I correct in doing that, or should I not have done 3 of them? Somebody help me on that.
I think it's your choice, Ann. Sometimes leaving the data in, sometimes taking it out, just to give you an idea of what the lower averages might be. But I don't see anything wrong. I think what you're doing is reasonable. And I think that's the key word to doing any SSG, is trying to be reasonable in making your judgments.
Well, I did it because I just thought they were so out of proportion to what they had been, and now they're going down. So anyway, well, thanks, Ken. But Morningstar has a fair value of this company right now for $296. And like I said, today's closing price was $271.18. So we're well below what their fair value is. And the current price is also well below the value line. Next page, please. This is my projections going forward. I put 30 as the high PE. I choose mostly not to go over 30. Sometimes I do, but this case I didn't. My low price is the 80% of the current price, which gives us a buy, and we're kind of right in the middle of the buy range. If you go over to the right, you can see both member sentiment and manifest investing's projections. Mine were certainly within the realm of what these are going for. And so I thought that my projections were reasonable. So this comes up a buy, and hopefully Thursday when they report that I will still agree with that. So this is my selection.
You're brave.
Thank you.
Going pre, it's a brave thing.
So was that quick enough for you, Ken?
Good job, Ann. Excellent
Perfect.
job. Okay.
Perfect.
Let's see if I can match your time, Ann. Okay.
Okay.
I'm taking the over.
I'm going to choose a stock that we've done before. In fact, I think Ann might have brought this to us just very recently. Parfums. I like it an awful lot, and I will say that I've been fooling with artificial intelligence, and I got this particular graphic by using some artificial intelligence to generate it. So I'm really being kind of happy when I'm doing this kind of stuff. It's giving me some interesting things. Next slide, Mark. I've circled a couple things from their most recent. This is an August investor presentation that Parfums has put on, and I've circled 2 things that were on the opening slide. The first one is compounded annual growth rate of their sales at 12% over more than 20 years. I think that's a very cogent fact to kind of keep in mind. And then the fact that this is a fairly decent sized company, and yet you see the founders and the CEOs really aligned with shareholder interest with a 44% insider stake in the company. As companies get larger, you don't see stakes this large usually in companies, but this one is a little bit of an exception. And since they have a lot of money in the game, I know that they're going to be doing things that are going to favor their own investments, and by extension, that would favor our investment as well. Next slide. This brands that Parfums provides fragrance to are all over the world. You can see the US brands, you can see the European brands, and many of those names are extremely familiar, especially to the men in the audience that are buying perfume for their wives and significant others and everything. A lot of very, very familiar names on the brand list. This investor presentation does a wonderful job of telling you how fast each of the brands is growing and what the strengths of that brand happen to be. Of course, I don't have time to get into all of that for as many brands as they have. Next slide, please. They're very acquisitive, and because they're very acquisitive, you'll see the debt to be a little bit higher than you might expect for a company like this. But you can see in the last 20 years or so, all of the different acquisitions they've made, the most recent being Lacoste. That's the little alligator that we grew so used to seeing in different decades in the last century. And Lacoste Fragrances is now part of what Inter Parfum provides fragrance for, and it's become one of their largest selling brands and fastest growing brands in their stable of brands right here. Next slide. In fact, here you are with some of the faster growing competitors to Inter Parfum. You've probably heard of Estee Lauder, and most of you have heard of Coty and L'Oreal as well. And you can see that Inter Parfum just really beats the heck out of their competitors. I know that they've probably chosen competitors where they align very well, but they have also chosen some of the largest competitors that exist out there. So I think it's a fair chart for them to present, and it's certainly a chart that shows that they have been extremely successful in the past. Next slide. It's a huge industry. Worldwide, global fragrance is estimated to be about $54 or more billion, and it's penetrated in a lot of different ways. Luxury prestige fragrance is more than half of the market. It's expected to grow at least at 6%. And the distribution channel is split between in-store and online. This is still something where there's a fairly large in-store presence because it involves the senses, and many times when you're buying a fragrance, you want to be able to compare those fragrances, and that's kind of hard to do online. Next slide. Inter Parfums business is about $4 billion. They do not manufacture the fragrances. They provide the know-how to help licensed manufacturers make the fragrances. They help the different companies come up with the fragrances. They help market the fragrances. They help streamline the processes by which these fragrances get manufactured and then put into very desirable containers. And Inter Parfum deals almost 100% in the prestige luxury end of the fragrance market. They're expected to grow somewhere around 10% this year, and that's expected to continue into the future. And again, the distribution channel is very focused on in-store because of the fact that it's involving the senses. Next slide. They sell through direct affiliates. They have fragrance stores where you can buy these fragrances directly. A lot of their business goes through distributors, and they have a huge presence in duty-free stores throughout the world. You can see their global presence in more than 120 different companies, with duty-free being a very large part of their business. It's something that you might not have thought about, you might not have expected, but duty-free is a real big business worldwide with luxury people that fly around the world on a regular basis. Next slide. The competitors are in licensed brands. You can see some of the names of their biggest competitors. I did a presentation on Louis Vuitton just about 3 or 4 months ago, and they are a competitor. So there's a lot of fragrance out there in the same general niche as Inter Parfum, but Inter Parfum is one of the largest players in this particular market space. Next slide. They have industry-leading performance. This slide, I think I showed you once already. Next slide, please. Here's their sales mix by region, a lot of it in North America, but pretty strong worldwide, even getting into Eastern Europe and South America. Next slide. they are not going to be lacking for partners. They get into long-term contracts with their partners, and you can see this list of all their brand names, and you can see that most of these partnerships extend well into 2030, 2031, and there are options for revising or keeping the contract going if certain targets are met. Those sales targets vary company to company, but very few of these are expiring very soon. So you can see that they're going to be maintaining a long list of brand names to service for a long period of time. The business has legs going forward. Next slide. There's the lines, certainly up straight and parallel. They did a little bit of a stumble in the first quarter, and they've begun to recover. I've used 10% for forecast future growth. That's coming basically from the company itself. And I'm using 12.5% for future earnings growth. And again, coming almost entirely from the company, but being verified by a lot of our trusted sources. That 12.5 nestles very comfortably in the middle of some of the different source material that you can read. I explained that debt is a little bit on the high side because they're very acquisitive, but they managed to keep that debt under the 33% limit that Better Investing suggests is acceptable for a company. A really good return on equity, and you can see that it's moving in an upward direction, and you can see that they've been moving their pre-tax profit on sales in an upward direction as well, focusing more on brands with bigger and bigger margins attached to them. Next slide. I'm using a PE, a high PE of 32, a low PE of 20. That gives me a PE average of 26. That puts the company in the buy zone. And I'm fairly comfortable with these PEs. They are significantly below the PEs that are the last 5 years average. You'll notice that in the past 5 years, the high PE averaged over 41 and the low PE averaged over 23. So I brought those down, but there's still PEs that are, in my judgment, reasonable, but they are a little bit on the high side for this very, very high quality company. Next slide. That gives me par values somewhere between 12.5 and 16.5. Those par values compare very, very decently to other sources. This company pays a decent dividend. For an average yield going forward, the dividend yields about 2%, and that's pretty good in today's market. The payout ratio for the dividends about 52%. And one more slide, if you would, Mark. Morningstar figures the company right now at Friday's price of about $125 is undervalued. They do give the company a narrow moat, both for the fact that it has all of this forward license agreements with so many different partners, and for the fact that there's a lot of proprietary information bound up in the fragrances themselves. Inner Parfums value line says that in the next 3 to 5 years, we might expect 10 to 20%. My 12.5% par nestles very nicely in that 10 to 20 range. Manifest suggests a par of about 14.5, which I think is in speaking distance to my 12.5%. So all in all, I think that the sources validate my study. And one more slide, Mark. I recommend that we add $1,000 of IPAR to the roundtable portfolio. We had IPAR, and I'm sorry, Annie, it wasn't you. It was Cy Lynch that brought it to us in June. And right now it's giving us a relative return of 1.1%. That means that since June, just in a couple of months, it's beating the market already by 1%, which is quite a feat in and of itself. Let's go on to our next presenter, Mark.
Yeah, I think Ann actually presented it at one of our panelist sessions for one of the conferences we've done.
I agree.
All right, so with that, we're going to switch to Matt, and I'm going to go ahead and switch him to the presenter.
All right, ready to receive.
Because he's got some clicking to do.
I'm going to see which one.
Did that come through to you, Matt?
I think so.
We're seeing we're seeing a beautiful lighthouse, Matt, and now we're seeing your screen. If you can make it fill the whole screen.
Sorry.
He's on it.
It went the wrong way. Yeah, it's on my other screen. Sorry. Here, let me switch. There you go. I'm burning a minute already. We didn't get a chance to practice. Here we go. How about that?
Sounds good. Looks good.
All right. So I was interested after the issues that many discount brokerages had on August 5th to see if there was some consequence to that, some group that might benefit from that. The obvious answer would be a broker that didn't crash. But I was open to other ideas as well. You know, we'd all been conditioned to look for such things after the CrowdStrike incident in July, and they kind of had this. I'm sure a lot of us, most of us, felt this as we didn't have access in the morning that day. But I came across a very interesting case of Interactive Brokers. So Interactive Brokers was founded in 1977 by Thomas Petterfy. He is a immigrant from Hungary, came in 1965. He just called it TP and Company, you know where that is, or how he got that. They renamed themselves as Timber Hill in 1982 and were focused originally on market making, particularly options market making. They eventually added a brokerage subsidiary, which is Interactive Brokers, in the 90s. In response to the opportunity to grow not only in the market making part of the transaction, that is the spread in bid and ask, but to actually execute trades too. One thing I do like, and so just to say, Thomas still runs the company. I do like the fact that that the founder sold his baby. So in 2017. If you think in that time frame, that was shortly after Michael Lewis published Flash Boys, right? This was when high-speed traders were all the rage. And the company found that their market-making business went from generating $800 million a year in profit to actually losing $20 million a year. They would either have to engage in the arms race for speed or get out of that business, and they chose to get out. So I really like a founder who's rational enough to sell his firstborn in order to work on the business that's successful. So they're a broker. You can see they're a broker for much more than stocks, pretty much everything you can think of. They partner with 200 introducing brokers, which is essentially they white label their service. So they're actually expanding right now quite a bit with HSBC Bank, one of the biggest banks in the world. But they have a large number of banks, brokers, hedge funds, and things which are using their infrastructure essentially to run their business. And then they IPO'd in 2007. Their full year statistics for last year, that process on average 3 million trades a day. I don't know why I'm getting this kind of heartbeat going through here, which is interesting. You think about 2.6 million customers. So they average, every customer on average trades more than once a day or more than 200 times a year. Just as a note, going back to that August 5th date, they actually processed over 5 million trades just by 11 a.m., just in the first 2 hours of the market. They are primarily international, so they operate in 34 countries. Actually, just today, they announced that they're going to access the Malaysia Stock Exchange. They work in 27 currencies, and they work in these natively. So if you buy a foreign stock or foreign security from a typical U.S. broker, you have to exchange your U.S. dollars to go to their local currency, buy and sell, and then exchange it back. Interactive Brokers let you hold multiple currencies because they actually trade in foreign exchange as well. They have a $52 billion market cap, and 80% of their accounts and 50% of their commissions are from outside the Americas. So it's not just the U.S., but all the Americas. So again, primarily international. Just some early history. So this is a picture of Mr. Petterfy here, and he's holding a handheld computer he invented to take to the trading floor of the CBOE. they actually brought technology to a lot of exchanges and had a lot of pushback. You know, the open outcry, you know, people in the pit yelling at each other was kind of a culture. And so some exchanges were accepting of his innovations. Ones that weren't, for example, there's these crazy colorful patches. This was a signaling system that he invented when they couldn't take the computer online. They made a signaling system so his traders could sort of communicate or get ideas of what the computer agreed to it. Some exchanges didn't like that. And so they actually would hire, they said you couldn't point those at the traders. You could have them on the floor, point them at the traders, so they hired an intern to call in signals baseball style to tell them what the color patch meant. So this company is from its beginning relentlessly innovating on information, on bringing information, high believers in I'll say computer algorithms. They have a lot of technical traders, but in the processing of flow, and relentlessly efficiency minded and using automation to drive that. I think it's very much like Southwest in its heyday. It isn't a low cost broker in the sense that corners are cut. It's low cost in that they are ruthless executors of what they do. So here's an idea of sort of the pricing behind it. They do have this Interactive Brokers Lite. There goes my thing again. Oh, I think I know what's happening. Which they sort of added just as the $0 per share became the standard in the U.S. And understand, you know, there's no such thing as a free lunch. When you don't pay for your trades, what happens is your trade is sold to one of those high frequency traders who sort of makes tenths or hundredths of a cent in front of you to take advantage of the trading you're doing. Far more common for their customers is this bundle, and this is for trading US stocks, so that the prices are different whatever exchange you're on. They do charge a very small amount per share when you trade, but the promise is it will not only execute at the best price, the absolute best price, but the fastest as well. So they have, again, day traders, and you picture a guy in his room, but these are, you know, hedge funds, large operations looking to trade large amounts of shares or large amounts of securities very quickly. That is their core customer. Also, they have very interesting philosophy in terms of the rates that they charge and pay. You can see, not coincidentally, the interest rates they pay on savings is exactly 2% different from what they charge for margin rates. So they have by far the highest interest rate paid because, again, they have active traders for customers. They tend to have large cash balances to have dry powder on hand to take advantage of market volatility, like on the 5th. But they also have what seems to be kind of an unbelievable margin rate. And you wonder, you know, how could you make money charging half what everybody else does? Here's the thing. Again, remember, this is a relentlessly automating company. They don't issue margin calls. The idea that if you're on margin and you go below your collateral, they don't call you up to put in more collateral. They will sell your securities. And Thomas himself said, you know, the expectation is you're managing your account, right? We're not babysitting you. We're not asking. You are going to maintain it, and you know up front what's going to happen. So it goes through. So that allows them to have very reasonable rates and allow people who use that method a lot to sort of park there, right? That's an advantage they have that going anywhere else that would immediately double their cost. So here's the first blush of the SSG. Looks like great growth in all three, up straight and parallel with a little bit of bumpiness. But there's this kind of strange thing here on the top. They've had a super spike in 2023 in revenue, but then the sales estimate says it's going to go down 19%, and that caught my eye to say, you know, is this something weird has happened? Some major event is happening? What's going on behind there? So I went back and focused on the last 4 years to say, you know, this is a company that's apparently doubled revenue and almost doubled revenue again. What disaster is happening? Knowing that it's not at a 52-week low, the price is actually near the 52-week high to cause this to happen. So I went looking at a few references to see what was going on. Morningstar, Value Line, Seeking Alpha, Yahoo Finance. Now, Morningstar, of course, is the provider of this information. So I just started to make sure that we confirmed it was the information that was here and not some kind of interface error and better vesting's part. Is clearly higher than the next two. I put in Yahoo Finance here, and I knew better, but as an example, it looks to correlate Morningstar, but when you're looking at online sources, I always ask the question, where do they get their numbers from? So Yahoo Finance is not an independent correlation. They actually get them from Morningstar as well. So that's not really a valid source. But I also found this note in this box on Value Line was kind of funny. This is related, this is a footnote related to earnings, but it's kind of funny that Value Line actually kind of gave up trying to be pretty with us and started using GAAP numbers. And in fact, after looking at the 10Ks, I confirmed the Value Line numbers are actually the true numbers that the company reports going through here. Now, you know, maybe that's too scary and you run away. Maybe you like that. One thing that comes out that's good news is that with all this going on with revenue, actually all of those sources check out for both pre-tax profit and earnings per share. So it's not a matter of you know, looking at different sets of books, let's say that way. There is something going on with the revenue line, but when it comes down to earnings, which of course is how we assess the price that we're going to expect, everybody's in alignment and it goes through. So this is some sort of bookkeeping or interface error, not a matter of a problem with the company. So this is the company structure. It's a little complicated. The actual operating company is down here in the middle, IBG LLC. That's the one that existed pre-IPO. If you buy the stock, you own the blocks on the left. That's a publicly traded corporation. It has 25.4% economic interest in the operating company. The right-hand side is Mr. Petterfy's holdings, essentially. I actually recognize this structure. I used it, or I experienced it with Camping World, with Marcus Lemonis's Camping World. And so there's this remnant of an LLC, which only essentially holds this interest. It's literally a holding company. There's some tax reasons to maintain it for a long time, but there's this lingering issue of what the public corporation reports versus what the company actually has, which can cause those confusions like I had before. How confusing is it? Here's one measure. So when I look at the member sentiment tab on the SSG, we can see, and not only do we get a warning, there aren't a lot of studies. They've only had 24 studies in the past 90 days. If we look at the other stocks covered today, so Lululemon with a market cap of 33 billion versus 52 for Interactive Brokers has had 10 times as many. So has Nice, still coming up. And even Parfums, a much smaller market cap, has had twice as many. So it is a dusty hidden corner. Once you part the veil in here, it could be a point of finding value just because not too many people have looked at it. So that's one angle on this. The second angle is the stocks. If you look at I've taken a snippet of the historical data. This is the share count when you're doing the earnings projection on the earnings growth projection in the preferred procedure. It looks like the company has nearly doubled its share count, so diluted in half. What has actually happened, if you think back to that structure, is Mr. Petterfy has sold off some amount of his controlling interest. So in 2007 at the IPO, the public company had 40 million shares and had 10% of the company. Over time, over the ensuing 16 years, that amount has grown to the 108.6 million. This is actually, this is right, 108.6 million at the end of the second quarter, and has come up to 25.4% of share of the interest. So the dilution, the net dilution, is the difference between this blue line, which is the share count, and the economic interest, the orange line, is actually, instead of diluting 100%, has actually only diluted about 2%. So anyone calculating this using, let's say, standard procedure might grossly overestimate what share dilution has really brought to the company. So just to point out where we do this, you can actually go and override these default values, actually any default value, in the data menu, going to annual data and then quarterly data, because of course we're in the middle of the year. So again, I went to the sales column and I updated the numbers that I found that from the 10K, but lined up with Value Line. I left the pre-tax profit and earnings per share totally the same. You can see the lines I modified are marked with blue checks, and I also did the same for the quarterly amounts here as well. So just the revenue. So coming to that, we can see that what was the forecast for 19% drop actually is now in line with a growth company. Somewhat moderated growth. I also did not change these analyst forecasts. I did add value line in. But we still have this negative 19% here. I talked to Susie Artsberger. She said, well, it isn't calculated off this data. It comes from Morningstar. So simply ignore this. You will see those numbers again when you make your judgments through the SSG. So you have to continue to ignore them. But understand the data is fine. This little side piece is not reliable anymore. So I put a fairly modest revenue growth rate of 7%, which is a little bit more than value lines for the 5 years, but in line with the estimates. And understand they're actually outgrowing that a little bit in 2024. For earnings, I'll say there's nothing wrong with your screen here. I have blurred out the preferred procedure at this point because it's frankly quite obscene. If I put in a maintenance of the current margins and understanding that it's not really diluting shares, it's just Mr. Petterfee taking from the LLC to the corporate amount, it blows away historical EPS. I'll simply leave it at that. So I put instead a rather modest 12% growth rate. Again, looking at section 1, it is above value line, and I'll talk a little bit more about that now. It is a little under where they are in 2024 and roughly in line with the other estimates. Looking at section 2, pre-tax profit is amazing. It is mainly an information company, right? Trading, using its software to do business. Otherwise, it's a financial company. Quite strong. Return on equity has been quite strong, double digits since 2018. It's kind of a turning point here. Again, before this, they had that market making business, which was money losing in the end. And debt to capital is very minimal, but I call your attention to 2019 and 2017. Oops, there goes my bar again. Look at this company, and remember, they've only diluted 2% over 16 years. That includes these years. They've gone up to 50% and paid it off in a year. That's like a casino rate of paying things off. So they will use debt when it was super cheap back then. They don't like it. They're kind of allergic to it, and they still get good returns. Section 3 is pretty straightforward. The only thing I was a bit concerned, you can see that the high PE is kind of steadily going down over the years. I will note that the current one is back to 20 or 20.5, so a little back up this way. Something to watch, but it didn't scare me off. They do pay $1 a share dividend. They just did it last quarter, so it hasn't quite caught up with that. It's a little under 1% yield. That is only a 16% payout ratio. They generate a lot of cash and have not put that back into dividends, even though they also don't really use it in R&D. They are an investment house, so they invest it. Here's my judgments on the back. Straightforward for high price, 224. Forecast low price, I did use method A, so just low price times low earnings. You can see a few other ones are lower than that. Price dividend support is not too far off that if you want to look at that dividend, which is likely to grow. I have it as a buy. Morningstar calls it slightly overvalued with a 118 fair value, but it's also very high uncertainty. So you can see their sell zones and buy zones a little bit lower than mine, a narrow moat, and again, value line in line, let's say, with the high return. The low return is a little less enthusiastic, and I'll touch on that in just a minute. Average PE would be about market average. High PE would get to 14%. So let's look at Manifest. Manifest is a little different here because it is looking at book value. Analyzing this a little bit as a cross-reference, purely as a financial company. That isn't a par to really love, just 8.6%. But I'll point out a couple different things because I still end up now with 15.6%. The big thing is return on equity. I do have a little bit different share count too. Again, the share count goes up, but your portion of the company's real earnings go up too, so it's not dilution. The big thing is return on equity. So value line looks in 5 years for that to go back down to 11%, kind of more normalizing back to earlier years, which is what's showing on Manifest. I think that they have sustained an increase in return on equity because they've grown. Even with the new numbers, this company has doubled its revenue since 2020. And that has been a steady thing. It's not something that faded with the early pandemic like Robinhood. So they have a sustained growth. I'm not calling it 18%, which was 2023's peak. They will have some headwinds as interest rates go down. They'll maintain their spread, but the overall number won't go on or won't continue to grow. They'll have a couple little headwinds on there. But if they can maintain their 5-year average return on equity, it's a very nice company. And one final twist. Even Value Line, which isn't too excited about the company, admits the company makes too much money. You can see the highlighted amount I say here. What a problem they have. So the company doesn't do buybacks, and I haven't seen an express reason why, but I suspect it's because of their complex ownership. They did just double their dividend hike, or dividend from 11 cents to 25 cents. But again, a 15% buyback with only 10% spent on R&D gives a lot of cash that the company could continue to give back to shareholders. The analyst talks about maybe an annual dividend, maybe one-time dividend. Also, as a majority-owned company by the founder, it's important to note that the founder's kids don't really have an interest in the business. His son, William, is involved. He's kind of a new age kind of guy, so he's there for a fixed amount of time. He did not agree to stay long-term to help the company with environmental ESG concerns. So he's there to help out in his way. Also, a lot of companies with too much cash learn to throw it away in M&A. They do have a pretty good track record with acquisitions. The last one was Folio Investments, brought in 70,000 retail customers, but they walked away from 2 acquisitions in 2023 based on price. So that money is not burning a hole in their pocket, but it will be something they'll want to do with it. So that is Interactive Brokers.
Thank you, Matt. Let's go ahead and switch back to me, and we can ready for Kim. Did pretty good on time, Matt. We'll take that.
We're working on it.
Well, good evening, everybody. I do my stuff a little different, and I was looking at a technology stock in the AI area, and I went, oh my, they had too much debt. And as any person who knows, you look for a stock, sometimes one of the competitors looks a lot better, and this is what happened for me. I found and never had heard of Nice Ltd, but they are a technology company. They closed Monday night at $180.59. They are in the software area and inadvertently technology and AI. So this is another idea for an AI stock for you. They are based out of Israel, and the thing that's really nice about them is they make software systems and solutions that empower organizations to make better decisions. And I got that little thing that's of the business off of Value Line. So they take your data and try to give you better results. And they're also really high in the security area. And considering what they say, we're going to have as much security issues on our phones and cybersecurity. I like it also that this company is in that area. BlackRock owns it, as well as Capital Research. So, you know, some of the big guys really like it also, and it's been around for 38 years, so that's good. They've got a long history. Next slide. So the first place I go to look at is the Value Line sheet, and this is dated as of I think this was end of July 12th. I like looking at I have my little checklist. My checklist when I look at a Value Line sheet says, let's look at the projections, and I have a minimum. I want my low projection to be of annual return of a minimum of 10%, so that's a check right there. High of 21, I'm pretty happy with that. I like looking at the Legends box is going to come in later. Our PE at the time this Value Line was done, PE was 15.9, which I like because that's below the median of 28 or the trailing of 18, so it was undervalued then. current price was, when I looked at this, was I had set 180, so it's gone up 12 bucks in price. I was going to look to see how the PE is. And notice the middle of the screen, because I'd always wondered, how did Buffett and Munger just sit there and flip pages of value line, and how did they know that something was undervalued? And this is how. Value line makes the projections out, and if you look at the dot, dot, dot on the right-hand side, the low price was 245, and that is approximately halfway in between that, you know, 200 and that 320, so that's the 245. And they think the high price is 365, so that's way up there. And currently that's the projection, the dot, 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 and that black dot is underneath there. So that is telling me by just a quick visual analysis, I have found a stock that is probably undervalued. So right there, yeah, check mark. We're happy that we found something that's we got some growth there. So we've got a next slide, please, Mark. Here's the rest of the value line sheet. Now I kind of like going through everything side by side in my little checklist. Okay, so we can see revenues per, you know, it's an ADR stock, but the revenues for 2024 is supposed to be $44.05, but all the way out to 2029, $72.42. So that's not 100% return, but that might be 80, 85. I'm not going to complain. The cash flow per share in 2024 is supposed to be $13.35. That's also almost a double there at $23.55. Look at those earnings per share, $10.60, and it is a double to $20.25 by just a few cents we're missing. They don't have any dividends once they have had a special dividend payout that the value line said at the bottom. But what we see is a capital spending per ADR. That's only 60 cents. So one of the things that tells me, this is an asset-light company. So in other words, they don't have a lot of fixed costs that have to be into the company. And I like asset-light companies because then they don't have a lot of money tied up with having to have, like, utilities have to have lots of monies tied up, and then manufacturing companies have got buildings and machines they got to tie up money in. So this is an asset-light company. The equity per outstanding share, as you're looking to this year, is supposed to be at $62, and it's supposed to go to 58. It's going down a bit, but they've had a lot of growth going on. Now, if you'll notice that PE, what they're expecting to go out to 2027, 29 is 15. Well, if it was, last slide, Mark, if we're going to have a stock price that, our stock price is going to go all the way up possibly to 365, and our earnings are going to double by what the value line sheet said. If earnings are going to double and stock price goes out, then our earnings are going to go down. So that's where we're going to have capital appreciation. Go back to the slide. So that makes me excited about making money. So my operating margin is nice and consistent, 36.6, this year 37, all the way up to 41. So we got nice big fat margins, which is always good. Our net profit margin is 24, 25, going up to 28. So this is a company who is also very good at their capital allocation, and they know how to get as many pennies as they can out of every dollar. Their long-term debt is very low, and I like a company that can manage their debt and not tack on a whole bunch like a lot of companies did when we had the pandemic. Everybody thought the money was cheap, and so they tacked on debt, and now it's coming back to roost because interest rates have gone up. And they may go down, they may not. We'll have to time will tell, but a company that has a lot less debt, I like that. Last but not least, when you're looking at the return on total capital and shareholder equity, you've got something that is consistently going up. And that is how you can look by the numbers that you have a management that's great at capital allocation. So they feel very strongly to make sure if the money you're giving them and owning the stock, that your money is going to keep earning money for you because they're great at the capital allocation. Now, their long-term debt is only 12% of the total capital. They do have some annual rents. That's only like 22 million, which is pretty much nothing. And they do not have a defined pension plan, because these are all things that could take away from any growth, because the free cash flow is going to go elsewhere rather than back into the company. Next slide. Okay, they feel that the bottom line will, it's going to advance 21% to 1060 per share, and a strong revenue growth could lead to better operating leverage. They feel their earnings will likely step up by smaller at 19% to 1260. So if you're going to have revenues going up to 21% and earnings per share going up to 19%, yeah, I'm not complaining. So for the midterm right now, this may just not move a whole lot, but for the future, they're going to anticipating for that they've discussed having buying back shares, and that capital allocation, which is going to make our stock price go up, could be very appealing to our buy and hold investors. Next slide. So this is Kim's quick and dirty DCF. You take your projections box and you take your legend box from the value line on the front. You take the cash flow per share, which was $23.55. You minus the dividends, which is nothing, minus the capital spending of over 60 cents, which was giving us $22.95. You multiply that multiple of 15 from the legends box, you get $344.25. And if you look at the projections box, that is still less than what the high price of 365 is, which would be an annual total return of 21%. We as investors are usually pretty happy if we can get 15%. If I get 21%, I'm not complaining. It is more than 15. Next slide. Some of the news on the company is because like, how are they doing what they're doing to be so good at it? They've been recognized to be a top 10 vendor for leadership in AI on risk management solutions, which is that security stuff. They're also in a very niche market for digitally being able to help with their AI features to take all the information that is in a criminal justice case and put all that data in one location so that the prosecutors or the defense can all access it at the same time to make it easier for everybody to find it. They've been recognized as a leader for fraud management. They've been recognized for network exchange revolutions with their strategy that they have for AI. And their last quarter report had 26% year-over-year cloud revenue growth with continued double-digit growth in profitability. We all want companies who are profitable to make us money. All good things. Next slide. Here is what the Prove has for manifest investing. I look there. We have a quality of 97. You can't complain about that, but a potential annual return of 18.6. Can't argue about that one either. So all of this looks good. Next slide. So what I have found is a low capital intensive business. It has good management because the capital allocation in general has got high fat margins, and because you can see by the return on total capital and shareholder equity, has low debt. Looked at the share count or the ADRs, they pretty well can stay consistent, and the stock can increase the quality of a portfolio if you added it to yours by increasing your PAR. I like it. Next slide. I hope everyone would consider my stock as the one to be nicely added to the portfolio.
Thank you, Kim. Good stuff. All right, I'll go ahead and bring us home here in a couple of minutes. I'm going to go a little bit off the path a little here. Ken and I both do a best small companies process that we've been doing for almost 3 decades when it really comes down to it. But we go out and we try to find the best companies. That happens to be an AI picture that I had grabbed, and then I discovered that Ken's experimenting with AI also. We call these small companies red rabbits. You guys all probably know that. And Ken is finding some interesting artwork out there. But again, just quick reminders, small cap is not necessarily a small company. And it's also important to recognize that every once in a while you can take part of your portfolio, not the core part, but that small non-core speculative part, and go looking for some of these down here, and they can be a quite rewarding experience. Here's a quick reminder about what to expect when the Fed does cut rates, as they appear willing to do within the next month or so. Over the next 3, 6, and 12-month periods, the small caps do tend to perform fairly well because the economy gets a little bit of a jolt, and the response is felt faster and bigger with the smaller companies. For more perspective, small companies over the long term, that's why we put 25% in small, 50% in medium-sized companies, and 25% in large. The large companies is represented by this green here, and the smaller companies is here. Massive difference from just a fairly small difference in performance over the long term. So small companies are great. Here is our current shopping list, and this will take shape between now and October 31st, Halloween. And these are just kind of our general guidelines. We're looking for companies with less than $3 billion in sales, double-digit growth up at the top up here, very high-quality companies. We refuse to compromise. We think you can find smaller, faster-growing companies that have very good or excellent quality. And we also want a return forecast that's above the market average. So this is our current list. This will evolve and bubble and take shape over the next couple of months, but I think it's a great time to go shopping for smaller companies. There's several on here that I am not familiar with that we will become more familiar with. And again, you're just invited to engage. We talk about this a lot during our bull sessions, Tuesdays at 2, and we do archive those sessions also on YouTube. So I wanted to share tonight, I'm going to actually put double down on an investment that I had mentioned a few months ago. It's not a stock, it's an exchange traded fund, but this is run by First Trust. It's called their Small Cap Opportunities Fund. It's an exchange traded fund, but what you're looking at here is the top 25 tickers. And many of those are companies that have served us well in the small company, best small company work over the last several years, and in some of our favorite small company mutual funds. And again, we just look at this as a source of ideas for further study. Some of these companies are pre-earnings, and I know that sends a shiver down Ken's spine. And then some of them are pre-revenue, and I know that sends a shiver down everybody's spine. So you have to be careful with what you're looking at when it comes to these companies. But again, this is an example of a fund who seems to have a track record, pretty good track record for identifying good opportunities. You can go hunting there. Here is the track record since I first mentioned this. Here at the roundtable, I mentioned them last Halloween, celebrating our best small companies for last year. This is the performance of that exchange traded fund since Halloween, and I would argue that's done pretty well. In fact, we were stark raving geniuses between here and here, and then kind of sideways since then, but I think there is a pretty good field of opportunity out there right now. So with that, I'm going to go ahead and double down on that. We will keep track of that fund, and again, we will mine it, M-I-N-E, for opportunities, and we'll talk about them at bull sessions and probably here. So with that, Ken, you can go ahead and see what the audience is most interested in.
Well, here's your choices, folks. It's now your time to choose and put $1,000 into one of the 4 stocks we've presented, either Interactive Brokers, Parfums, Lululemon, Nice, one of those 4, and we'll make sure that money gets in there, and it will designate it from the audience. I'd like to have about 85 or 90% of you voting. We're up to 2/3 voting already. we just hit 3/4 voting, so we just need a few more of you to put some votes in. Doesn't cost you anything. Just take your mouse and click, or your finger if you have a touch screen, and do some clicking. We almost hit 90%, folks. Come on, let's get a few more of you voting. We can maybe hit 90% voting, and then we'll close this down and we'll tell you which one has won. Okay, we're going to close this down, and I'm going to share the results. And Anne, people really like Lululemon, so we're going to add another position in Lululemon tonight. 1/3 of the audience thought that Lululemon was the most opportune stocks. Matt, you and I tied for the goose egg tonight. Okay.
I think it's double digits. That's not bad.
And Kim, they like nice as well, but they like Lululemon just a little bit more. Okay.
Good stuff. Thank you.
Girl power all the way.
All right.
In keeping with the theme. All right. Just wanted to point out that we do archive all of these bull sessions and roundtables. You can see a couple of the roundtables on there. Most of the presentations over the last 14 years are there on the YouTube channel. Just search for Roundtable Manifest Investing. You'll find it. And if you can't find it, let either one of us know, and we'll be happy to try to help you out. Just some dates for the future roundtables coming up, and that note that, and Ken, we haven't talked about this, but I figure maybe that Saturday, November 2nd, might be the best for our Best Small Companies presentation.
Sounds like a wonderful date to put on the calendar, Mark, right?
You know, if we don't do that, we'll do it the next Tuesday, but it'll be in that time frame.
That Saturday sounds good. Yep.
And then we will be adding a few more events. We're hearing from chapters, and we'll be adding a few events here before too much longer. A little backstory on this. I used to attend Chicago Bull basketball games and sat fairly close to Oprah. Never actually talked to her, but I did talk to a couple of people. And, talked to Bill Murray. That counts for anything. But Oprah reached out to me last week and said, we've been having quite a few nights on these sessions. She wanted us to up the number of participating damsels, and I think that's a capital idea. So we made that effort. So thank you, Ann and Kim, for helping me out, keep me out of trouble with Oprah, because no one wants to get cross with Oprah. I told her she made a nice speech at the convention, but that didn't seem to take the edge off.
And I'll tell you, if there's any damsels in the audience that would like to be a part of the roundtable occasionally, drop your name to me or to Mark, and we'll certainly reach out. And it's not as scary as it first seems. We've had a nice long list of presenters over the years, and some of them have been able to come back and do a wonderful, wonderful job. So we're gonna mine that list a little bit, and we'd love to get some new names into the roundtable as well. So if you're itching to make a presentation about a favorite stock, drop us a line. Let us know that you have an interest, and we'll see what we can do.
Very cool. Thank you, Ken.
With that, I think I'm going to wind up the session. We do have a couple of questions, and Nick is just saying, do you see that one night is cheating by looking at what the damsel is typing? Okay. Mark, who is that one? Do you know?
Well, see, we tend to encourage the borrowing and sharing of ideas, in our community. So we'll go with that. So we'll look at it.
Okay, sounds good. So again, a great big thanks to Kim and to Ann and to Matt, and a special big thanks to Mark for doing all that he does for the roundtable. I think I told somebody before this began that as long as the audience keeps coming, we'll keep coming. We really enjoy this program, and we think it serves to illustrate a lot of really important things about growth investing. And with that, I'm going to say good night to everybody and wish you all well, and hope we see you a month from now at the next roundtable. Good night, everyone.
Thanks all.
Good night.